Let's face it, being a director is great. You're the boss, you call the shots. But when it comes to paying yourself, one wrong move and suddenly HMRC is dining on steak while you're stuck with beans on toast. In this video, I'll show you how to avoid overpaying yourself in 2025. You'll learn the tax efficient sweet spot for your salary, how to mix it with dividends, and most importantly, how to keep more money in your pocket while keeping HMRC happy. So grab a cuppa and a biscuit, or three, and let's get into it. First, let's start with the optimal director salary for 2025. This year, the magic number is 12,570. Why? Because this is the personal allowance threshold, and it means you won't pay any income tax on this portion of your income. But there's another important number to consider, the national insurance threshold. Now, as a director and an employer, you want to pay yourself just enough to stay above the lower earnings limit, 6,396, so you qualify for state pension contributions, but below the primary threshold, 12,570, to avoid paying national insurance. So the sweet spot for most directors is setting your salary at 12,570 per year, and this keeps things tax efficient whilst securing your state pension. However, there's a third number to take into account and a possible pitfall if you aren't aware of it. Employers' national insurance threshold, currently at 9,100 per year until the 5th of April. This means if you take less than this in salary, you'll have no tax or NI to pay personally, but you will have to pay employers' national insurance on anything over that threshold. And that's why the most commonly advised director's salary currently is £758 per month. If you've got 2 or more people on the payroll, however, the company's potentially eligible for employer's allowance and can reduce any liability by up to £5,000 per year currently. So you could take salary of £1,047.50 per month if you have another employee on the payroll and not have any employer's NI contributions. Worthwhile employing another person. Be aware though that from the 6th of April 2025, the employer's NI threshold has been nearly halved to £5,000 a year. Not as big an issue if there's another employee on the payroll as well as yourself, but if it's just yourself, then your company will pay employer's NI on any salary over £416 per month, roughly. But paying yourself isn't just about your salary. Dividends are the other piece of the puzzle. Dividends are taxed differently. They're not subject to national insurance, which makes them a great way to take money out of your company tax efficiently. Now, here's the ideal strategy. Pay yourself a small salary of £12,570 to utilise your personal allowance. Then take the rest of your income as dividends, staying within the dividend allowance of £500 and the basic rate tax threshold of £50,270, including the salary. So a total of £50,770. This combo reduces your overall tax bill and leaves more money for you to spend on the things that matter, like your next holiday or your growing collection of half-used stationery and pens. Of course, 2025 comes with some new tax changes you need to know. For example, dividend tax rates have increased, so basic rate taxpayers now pay 8.75% on dividends above the £500 allowance, instead of the £1,000 allowance, which was in place for the 23-24 tax period. And corporation tax is now at 25% for businesses with profits over £250,000. However, if your profits are £50,000 or less, the CT rate is still 19%, and in between these amounts, the rate's variable depending on your profits. But these changes make it even more important to get your salary dividend mix right. Overpaying yourself through salary could cost you more in tax and NI, and let's be honest, no one wants to hand over more cash to HMRC than they absolutely have to. Now, you might be thinking, why not just pay myself entirely in dividends? While dividends are great, there are a few hidden benefits to paying yourself a small salary. For example, state pension contributions. By paying yourself above 6,396, You ensure you qualify for state pension in the future, if there is any. Tax-free benefits. A small salary opens the door to perks like employer pension contributions, which aren't taxed as personal income either. Then corporation tax savings of a minimum of 19% of whatever salary you take. For example, a salary of £12,570 will save you a whopping £2,388 of corporation tax. These little benefits can add up over time, so don't overlook them. Now, let's talk about the risks of overpaying yourself. Here's what happens if you set your salary too high. You'll pay more employers' national insurance, reducing your company's profitability. Your personal tax liability will skyrocket if your salary pushes you into the higher tax bracket, which is $50,270 or more. Let's break this down with some real examples. So scenario 1, you pay yourself $12,570 as a salary and you take $30,000 in dividends per year. The result? Minimal tax and NIC, leaving more in your pocket. Scenario 2, you use a mix of salary at $6,500, dividends of $35,000 and pension contributions of $10,000. The result? Maximum tax efficiency, as both salary and pension contributions are tax deductible. So let's talk about some common mistakes directors make. Paying yourself below the lower earnings limit and missing out on state pension contributions. Also, not taking a salary at all and missing out on state pension contributions and corporation tax savings. Forgetting to review tax changes annually for NI thresholds, changes to allowances and tax rates as well. Avoiding these pitfalls will keep your business and your personal finances running smoothly. The amount of times I talk to clients and customers who come to us and they've not kept up to date with this and they're not paying themselves enough, or they're paying too much through salary and it's not benefiting them or the business. Now, if you found this guide helpful, don't forget to hit that like button and subscribe for more tips on running your business smarter. Thanks for watching and I'll see you in the next video.